On Business Incorporated today. Zimbabweans protest shortage of public transport in urban areas. Kenya reconsiders decision ahead to sell $1 billion Eurobond. And Democratic Republic of Congo to issue oil bonds. It's the final one for the week. Welcome to Business Incorporated on Channels Television. I'm Ini John Mekwa. We begin as usual with market numbers in Africa, where trading sentiments were mixed. At the intraday, Nigeria's main index sustained that green trading. It's up 0.15%, while South Africa's index had a bigger move in the red. It was down 2.26%. Egypt's equities market closed Thursday. However, its index closed up over 3%, while Nairobi's stock exchange ended Thursday's trading in the negative territory. To the Middle East now, where major equities in the United Arab Emirates traded in mixed territory. Abu Dhabi was up 0.29%, while Dubai's index was down almost 1%. Still within the region, Saudi Arabia closed in the green on Thursday, up 0.66%, while Qatar index closed down 0.16%. Let's head to the UK now. The elections, outcome of the elections and what it reflects or what it tells us about the cost of living in the UK is what we're excited to hear from Juliana. Juliana is joining us from Westminster. Hello, Juliana. Good afternoon.
Good afternoon, Innie, from Westminster. I'm just outside Parliament now.
Yeah, so what's the outcome of the election? How are the results looking? What does it tell us?
Well, going into the election, I think a lot of people were saying that this was a referendum on the tenure of Prime Minister Boris Johnson leading up to the campaign. We didn't really hear much about levelling up, which was a big manifesto pledge. It was already really dominated by Partygate and scandal upon scandal. And I think the Labour Party, led by Sir Keir Starmer, were hoping that they would be able to gain some significant strongholds because of the despair of the British public. But it doesn't appear to have been reflected that way. Yes, there have been some significant losses from the Conservative Party in London. London has always been a left-leaning city, but it is the commercial hub, so it does have some importance to the Conservative Party, particularly as most of them that sit in the benches just behind me in Westminster live here in London. I actually do have somebody to speak with right now who we've bumped into, Femi Oluwale. This gentleman is going to be known not only by members of the public here in the UK, but of course sometimes his commentary does send tingles down the spine, shall we say, of some MPs here in the UK, and I'd like to get his perspective if I could, Innie. Firstly, lots of people, Femi, were saying that the Labour Party should have taken more seats. What's your initial response to some of the results that we've had so far?
I think there was always going to be a degree of loss from the Conservatives, given that people are really struggling right now with the cost of living. People are having to choose between heating their homes, feeding their kids, fueling their cars, and what they want to know is that the government cares about them. And Partygate was a real sign that the government doesn't actually care at all. And so I think that would explain some of the losses. Why Labour hasn't done so as well as they could have potentially done is because Keir Starmer hasn't been particularly clear as to what his vision for the UK is going to be moving forward. And so we've seen things like 83% of Labour members want him to support proportional representation, but he's been silent on that. We've seen lots of calls, lots of his failure to stick to some certain manifesto pledges in terms of his leadership election. And so there's a lot of distrust there.
Very briefly as well, Innie, I'm not sure if you have seen this breaking news, but Sir Keir Starmer, the leader of the Labour Party, will now be investigated by Durham police over, I think the press here in Britain are calling it Beergate. I'll just quickly get a response from Femi whilst he's here on that. I know you haven't had much time to look at that headline, but a significant significant development?
It's definitely significant that they're investigating. We'll see whether or not there'll be anything that comes of that. But I would still think that this is still one event compared to the 18 that we know took place in Downing Street. So there'd be a danger of having a false equivalent between the two of them.
Okay, thank you so much, Femi Oluwale. Thank you, Ini and the business team, for allowing that impromptu interview. Over to you in the studio.
Yeah, thank you so much, Juliana. You certainly have a lot of stories to chase out there, and we'll get it into the programs in our subsequent conversation. Thank you so much, and well done. Well, let's move to Europe now. And the EU is closing in on the 6th round of economic sanctions on Russia over its war in Ukraine. We have Chelsea now joining us to tell us what to expect from all the talks. I think we have some ideas of what the 6th round of sanctions are about. But hello, Chelsea. Good afternoon. So from your end, what are we looking at? What are some of the perspectives given to this 6th round of sanctions?
Well, EU officials are in marathon negotiations in Brussels right now. They're hoping to get this next round of sanctions passed over the weekend, but the path there is going to be difficult. The biggest news from this round of sanctions is a ban on Russian oil. It's supposed to be phased in about 6 months. This is a big step because so far the EU has been quite reluctant to implement bans on Russian fossil fuels, but this is something that's on the table now. The viability of this proposal is a bit tenuous. In the past hours, Hungary's Prime Minister Viktor Orban has said he will not support this sanctions package, calling it an atomic bomb for the Hungarian economy. The EU has said Hungary, as well as Slovakia, can take longer to introduce this ban on Russian oil because of how dependent their economies are on Russian oil. They want 2 years. It does seem that the EU will give in to that and allow them a 2-year phase-in for this oil ban. Another part of the sanctions package would be disconnecting Russia's largest bank, Sberbank, from the global messaging system SWIFT. That would be a big escalation in penalties for Russia's financial system. Another interesting part of this sanctions package would be a ban on property transactions from Russian nationals. Many Russian oligarchs, as we know, have used their wealth to buy properties in Europe, French villas, things like this. This would mean that they couldn't sell those properties or buy any new ones. So on top of the travel bans, the seizures of things like mega yachts that we've already seen in previous sanctions rounds, this would definitely be another blow to Russia's wealthy.
And it's been an exceptionally volatile week for global markets with the interest rate and all of that. How are European investors feeling? Are they bracing up for the bear market?
Well, EU officials are in marathon negotiations in Brussels right now. They're hoping to get this next round of sanctions passed over the weekend, but the path there is going to be difficult. The biggest news from this round of sanctions is a ban on Russian oil. It's supposed to be phased in about 6 months. This is a big step because so far the EU has been quite reluctant to implement bans on Russian fossil fuels, but this is something that's on the table now. The viability of this proposal is a bit tenuous. In the past hours, Hungary's Prime Minister Viktor Orban has said he will not support this sanctions package, calling it an atomic bomb for the Hungarian economy. The EU has said Hungary, as well as Slovakia, can take longer to introduce this ban on Russian oil because of how dependent their economies are on Russian oil. They want 2 years. It does seem that the EU will give in to that and allow them a 2-year phase-in for this oil ban. Another part of the sanctions package would be disconnecting Russia's largest bank, Sberbank, from the global messaging system SWIFT. That would be a big escalation in penalties for Russia's financial system. Another interesting part of this sanctions package would be a ban on property transactions from Russian nationals. Many Russian oligarchs, as we know, have used their wealth to buy properties in Europe, French villas, things like this. This would mean that they couldn't sell those properties or buy any new ones. So on top of the travel bans, the seizures of things like mega yachts that we've already seen in previous sanctions rounds, this would definitely be another blow to Russia's wealthy.
Yes, and everybody seems to be talking about rate hikes. Now, we have some officials from the ECB expressing their perspective and expectations about it. What do we know about this?
The takeaway is that a summer rate hike, it's starting to really solidify. We've heard this week from multiple ECB officials that they do expect a rate hike either in June or July. And what's interesting is that some of the ECB's most dovish members, particularly the Finnish governor, Olli Rehn, says he does think rates should rise in July and again in September. So this is a big deal because the ECB has been dovish for so long. Interest rates have been negative here in Europe since 2014. And so it is a major shift to see the ECB considering rate hikes at all. And all investors do expect 3 rate hikes from the ECB this year. That does mean that the ECB is still going to be trailing the Federal Reserve, which delivered its biggest rate hike in 22 years this week. But what we heard from the ECB's top economist, Philip Lane, yesterday is that this divergence is warranted because the EU economy is still quite a bit weaker than the US's. Wages, for one, are rising slower here at about a 3% rate in Europe compared to about 5% in the US, according to recent data. As well, Europe's economy is going to definitely get hit harder by the war in Ukraine. So we're talking about a recession here. So that means that the ECB is going to remain likely the most dovish of the major central banks.
Thank you so much for that update. Enjoy your weekend. Let's move to Asia now. Shares in Asia Pacific largely declined on Friday after an overnight drop on Wall Street sent the Dow Jones Industrial Average to its worst day since 2020. Hong Kong's Hang Seng Index led losses regionally as it fell 3.81% to close at 20,001.96. In mainland China, the Shanghai Composite slipped 2.16% to end the trading day at 3,001.56, while the Shenzhen component shed 2.14% to 10,809.88. South Korea's Kospi dropped 1.23% on the day to 2,644.51. S&P AX 200 in Australia shed 2.16% to close at 7,205.60. Singapore Straits Times Index slipped 1.39%. Japanese stocks bucked the overall trend regionally as they returned to trade today after being closed for holidays much of this week. Nikkei 225 closed 0.69% higher, 27,003.56. Our Topics Index gained 0.93% to 1,915.91. MCSI's Broadex Index of Asia Pacific shares outside Japan fell 2.74%. And in the United States, stock futures were lower in early trading after the Dow Jones Industrial Average posted its worst day since 2020. Futures on the Dow Jones Industrial Average were down 153 points. S&P futures traded 0.7% lower, and NASDAQ 100 futures fell 1%. We'll have our correspondent in Washington now, Maria Bird, to tell us the details of yesterday's trading.
The U.S. stock market fell sharply on Thursday as the Dow Jones tumbled more than 1,000 points. It is clear that the end of the day ended at negative 3.12%. The NASDAQ also fell on Thursday as well. The heavy tech industry, companies like Facebook and e-commerce companies, were falling by more than 6 and 7% on the day, which ended the NASDAQ's overall day at negative 4.99%. The S&P 500 also fell on Thursday. It fell by 3.56% down. It is very clear that the Chairman Powell's announcement on Tuesday afternoon rallied the stock market on Wednesday. But Thursday is a much different story. We'll continue to watch to see what is next for the U.S. markets.
We'll certainly continue to watch and see how the market reacts to all the parameters that are pressuring it from all sides globally. Well, I will take a break now. When we come back, we have more stories from you. This time they'll be coming from the African continent. So stay with us. This is Business Incorporated on Channels Television. Hey, welcome back. You're still watching Business Incorporated here on Channels Television. Well, just before we go to South Africa, let's do South Sudan. Well, crude oil there has been sold in advance for the next 5 years. This comes on the back of civil servant salaries not paying since January. And the Minister of Finance explained that to pay the salaries will require borrowing, which means that the country's oil is being sold in advance. The oil-rich nation produces roughly 150,000 to 170,000 barrels a day. But because of the share owed to oil companies and fees paid to Sudan, it earns income from 45,000 barrels at most. And South Sudan ranks third in oil reserves in sub-Saharan Africa with roughly 3.5 billion barrels produced annually. Still, 90% of the gas and oil reserves are untapped. And the government says it is working to increase non-oil revenues to reduce dependence on oil revenues. So we go to South Africa now. This week, we've had a lot of stories coming from South Africa, from the Moody's credit rating, which says that inflation will hit 10% this year in South Africa. And, well, we have joining us now from London to discuss the outlook for South African economy, Matt Kindiga, practice lead Sub-Saharan Africa Front of View. He has his eyes on South Africa, and he's telling us how this projection goes, or how if South Africa can escape it. Hi, Matt. Good afternoon. Good to have you on.
Hi, good afternoon. Thanks for having me on the show.
Great. So given the weak recent data, what's your outlook for industrial activity in South Africa? I know the PMI came out and it didn't look so good. So it was a drop from 60 to 50 points.
Yes, that's right. So PMI, especially manufacturing PMI in South Africa, was actually improving quite significantly over the last couple of months. The industrial sectors in South Africa, manufacturing, mining, were gathering momentum, and we have seen quite a significant reversal over the last month or so. And this is really mainly a direct result of the quite dramatic floods that we saw in KwaZulu-Natal over the last month or so, specifically in the Durban area. There has been significant disruption to port activity in Durban. Durban is South Africa's most important import and export port, and a lot of export-orientated companies have struggled to get their goods out of the country, but also a lot of components that are used in industrial processes have been held up at sea because the port has been out of action. So that's really one of the factors. The other factor is that power shortages have weighed on production as well. And in terms of the outlook, it's a bit of a mixed picture for South Africa's industrial activity in particular. So the floods aren't likely to have a long-term impact on industrial activity in South Africa. We expect a relatively quick recovery, probably by the third quarter this year, so over the next couple of months. And we're also going to see very high commodity prices support activity in some industries, such as mining. So certainly there are a couple of positive drivers for industrial activity, but there are a few things that will contain the sector's prospects. Notably, we're going to see quite weak export demand for some of South Africa's key exports. So, for example, the automotive industry in South Africa, very dependent on consumer sentiment in Europe, exports a lot to Europe. We're going to see a slowdown in consumer spending in Europe this year, and this will weigh on South Africa's automotive exports. We're also going to see continued problems with power shortages in South Africa, and this will continue to undermine productivity and raise costs for the industry. So there are a couple of things that will weigh on the outlook for industrial activity for sure.
Yeah, and looking at from Moody's eyes, do you see what Moody's sees when it comes to inflation?
Yeah, so this is quite an interesting development today. They expect, I believe, an average annual inflation rate of about 8%. For South Africa in 2022, we are forecasting 7.5% as an annual average this year, which will be the highest rate since at least 2008. So South Africa has enjoyed more than a decade of quite low inflation. We expect the inflation rate to well exceed the government's upper limit of 6%, especially in the second half of the year. We could see the inflation rate peak in Q3 or Q4 at over 10% year on year. And this is being driven by very high fuel prices. We are expecting global oil prices to remain close to or above $100 a barrel for the rest of the year. But South Africa also is very exposed to high global agriculture prices. We're probably going to see a bit of a spike in agriculture commodity prices and therefore food prices in South Africa also towards the end of this year. And in South Africa's case, quite uniquely, Eskom, the state utility or energy utility, is really desperate for extra funding. And so as a result, it is raising electricity tariffs, even though there are electricity shortages in the country. This will also be a significant contributor to higher inflation in South Africa over the course of 2022.
So how should the government and the central bank be responding to these forecasts?
Yeah, certainly. So in terms of industrial activity, so the government is very aware of the constraints on the industrial sector. We've seen a couple of things already take place. So an expansion of the role of independent power producers to allow big industrial companies to generate their own electricity. We're already seeing this occur in the mining industry. We're probably going to see more manufacturing subsectors also invest in independent power production. The government's also prioritizing in its budget over the next year investment in infrastructure, especially transport infrastructure and railway infrastructure. So we're certainly going to see a bit of a helping hand from the government in that regard. But from an inflation perspective, so the government's hands from a fiscal perspective are quite tied. It has very limited tools to contain cost pressures in terms of using extra subsidies or tax cuts. And this is because the government has a very strict goal of cutting its budget deficit and public levels of public debt by the middle of this decade. So we don't see a significant rollout of new subsidies, for example. But from the South African Reserve Bank's perspective, we certainly are expecting more interest rate hikes over the next few months and throughout the rest of this year. And this is because the rand has lost a fair amount of value against the dollar over the last couple of weeks, partly as a result of the Fed increasing its interest rate by quite a substantial amount in the US over the last couple of weeks. But we're also likely to see the independence of the central bank mean that it will be forced to revisit its remit of pulling down the inflation rate in South Africa. So certainly we are expecting much tighter monetary policy over the next couple of months, and that could contribute to a slowing of inflation towards the end of the year and the beginning of next year.
All right, Matt, thank you so much for giving us your perspective on the South African economy. Do enjoy your weekend.
Thanks, you too.
Oh, we have a couple of stories now. Just before the curtains close, Air Botswana has recommenced direct flight to Zimbabwe and Zambia with effect from today. The plan is for a 2-weekly direct flight on Fridays and Sundays, with frequencies increased to 3 weekly as demand builds up. The airline will deploy its Embraer 170 jets to service the routes and some of its regional routes. And that's the much we can take on the program today. Thank you so much for being a part of it. We'll do it again next week. I'm Ini John Mekwa. Enjoy your weekend.